Okay, so here's a number that should stop you for a second. If you'd split $1,000 evenly across Google, Apple, and Amazon back in 2010, the three stocks everyone was telling you to buy, you'd have turned that into a genuinely solid return by 2020. If you'd put that same $1,000 into Domino's Pizza instead, you'd have ended up with meaningfully more money than the tech basket produced, from a company that sells a $7 pizza out of a cardboard box. Subscribe before we get into this, because by the end of this video you'll understand why a delivery chain most people think of as fast food actually behaves like a logistics and technology company wearing a pizza box as a disguise, and why owning one of these franchises is a completely different bet than the brochure makes it look like. Let's start with what it actually costs to buy in, because the number that gets quoted first is almost designed to feel approachable. The franchise fee itself, the check you write Domino's just for the right to use the name, typically runs somewhere between $10,000 and $25,000, depending on whether you're opening new, converting an existing space, or buying into the system through other channels. And on its own, that number sounds almost reasonable next to what other national brands charge. Then you get into the real figure, and current disclosure documents put the total initial investment for a traditional Domino's location somewhere between roughly $120,000 and $740,000, a genuinely wide range driven by market, real estate situation, and whether you're building new or taking over a converted space. Domino's wants to see a minimum net worth around $250,000 and at least $75,000 sitting in liquid capital before they'll seriously engage with you, which is actually one of the more accessible thresholds among major national quick-service brands. And that's not an accident. It's a direct reflection of how the company built its entire model to keep the entry cost low. And here's the part that catches a lot of first-time applicants off guard. Domino's has a well-documented, strong preference for franchisees who came up through the system itself, store managers, shift leads, corporate employees who've already proven themselves running someone else's location before ever being handed their own. Walking in cold with the required capital and no operational history inside the brand is possible, but it's genuinely the harder path in. Once you're open, this is where most people evaluating a franchise stop doing the math they actually need to do. Domino's collects a royalty of 5.5% of your gross sales, not your profit, your gross sales, every single week, regardless of whether that week made you any money at all. Layer an advertising fund contribution on top, typically landing somewhere between 4 and 6% depending on the specific agreement, and the combined fee burden running back to corporate lands around 10 to 11.5% of everything your store brings in, which sits meaningfully above the industry average for quick-service concepts generally. Run that against a location doing something close to the reported median unit revenue, a bit over $1 million a year, and you're looking at somewhere around $110,000 to $120,000 leaving your account annually before you've paid a single employee, bought a single block of mozzarella, or covered a single month of rent. Now add the actual operating costs. Food cost in the pizza business typically runs in the high 20s to low 30s as a percentage of revenue, and labor for a delivery-heavy quick-service operation commonly lands somewhere in the mid to high 20s as well. Add rent on a space that, unlike most restaurants, only needs to be around 1,200 square feet, rather than the 3,000 to 5,000. A typical sit-down concept requires, plus utilities, insurance, and equipment maintenance, and by the time every fixed and variable cost is stacked up, the gap between the impressive top-line revenue number and the actual profit sitting at the bottom is considerably smaller than the enthusiasm in a franchise brochure would suggest. Here's the part almost nobody explains correctly, and it's the entire reason Domino's trades more like a software company than a pizza chain. Your individual store isn't really the core of this business. It's the delivery mechanism for a much bigger machine sitting one level above you. Domino's operates dozens of regional dough production and supply distribution centers across North America, facilities that manufacture fresh dough daily and supply franchise locations with sauce, cheese, boxes, cleaning products, and equipment. A majority of Domino's total corporate revenue comes not from royalties, but from selling ingredients and supplies to its own franchise network, which means the franchisees who took on all the real estate risk, the labor management headaches, and the day-to-day operational stress are simultaneously the parent company's single largest customer base. That structure converts what would normally be volatile restaurant revenue into something far closer to guaranteed corporate income, since whether your particular store has a great month or a terrible one, Domino's still collects the royalty, still collects the advertising contribution, and still collects the margin on every pound of cheese moving through its distribution network. To keep participation high, Domino's actually shares a meaningful share of the pre-tax profit generated by those regional distribution centers back with participating franchises, which has pushed voluntary participation in the supply system to something close to universal across the domestic network, turning what could have been a contentious compliance requirement into an arrangement franchisees genuinely want to be part of. Now for the origin story, because understanding how this company got built explains why the model looks the way it does today. In 1960, a 23-year-old named Tom Monaghan and his brother put down a small deposit on a struggling pizza shop in Ypsilanti, Michigan. His brother traded his half of the business away for a used car within the first year. Tom kept going, and what he built wasn't the product of some grand strategic vision. It was a series of cost-cutting decisions made by someone trying to keep a small, struggling business alive. He cut the dining room entirely, since it demanded square footage, furniture, and front-of-house staff he couldn't afford, simplified the menu down to essentially one product, and concentrated everything around delivery. That decision alone, need for roughly 1,000 square feet instead of several thousand, quietly built the entire economic foundation the brand still runs on today: dramatically lower rent, lower build-out cost, and a lower break-even threshold than a traditional sit-down pizzeria could ever achieve. The insight that turned that scrappy foundation into a genuine empire was the 30-minute delivery promise introduced in the early 1970s, and the point of it was never really the guarantee itself. It was that the promise forced every operational decision inside the business, kitchen layout, staffing schedules, driver routing, to be optimized around a single measurable outcome. It worked for 2 decades, until the pressure it created around driver behavior led to a serious accident and a massive legal judgment in the early 90s, and the guarantee was retired for good. But by then, the brand's reputation for speed and reliability had already been built into the public's mind, and that reputation quietly outlived the specific mechanism that created it. By the late 2000s, Domino's ran into a problem no amount of delivery speed could fix. People genuinely didn't like the pizza. Internal customer research came back brutal, comparisons to cardboard and ketchup, and satisfaction had cratered. Rather than quietly reformulating and hoping nobody noticed, incoming leadership made the unusual decision to put real customers on national television saying exactly how bad the product was, then showed the company acknowledging it and rebuilding the dough, sauce, and cheese from scratch. Same-store sales jumped double digits in the very next quarter, the largest single-quarter gain the fast food industry had seen, because radical, uncomfortable honesty is something almost no brand actually attempts, and the shock of it did more reputational work than any polished advertising campaign could have. At almost the exact same moment, Domino's made a second bet that would define the next 15 years, building its own ordering and delivery technology in-house rather than outsourcing it the way most restaurant chains did. A real-time order tracker launched in 2008 solved a genuine operational headache, freeing up phone lines that used to be jammed with customers calling to ask where their food was, and over the years that followed, the company expanded into app ordering, smart device ordering, and even AI-driven voice ordering that eventually handled a significant share of phone orders without adding headcount. Today, the overwhelming majority of Domino's domestic sales flow through its own digital channels rather than through third-party delivery apps, and that distinction matters enormously financially, since every order placed directly through Domino's own app avoids the 15 to 30% commission a delivery aggregator would otherwise take, a difference worth an enormous amount of money at national scale, and one that also means Domino's, not a third-party platform, owns the customer data and the reorder relationship. So what does ownership actually look like in dollars? Take a strong performing location doing around $1.5 million in annual sales in a good suburban market with limited direct competition. After food costs near 28%, labor near 26%, combined royalty and advertising fees around 11%, and rent, insurance, and overhead on top, a well-run store can realistically clear somewhere in the mid to high $300,000 range in operating income before debt service, putting equity payback in well under 3 years if that volume holds steady. Now the harder version. Cheese prices spike, minimum wage increases push labor costs up, and a delivery aggregator starts aggressively discounting to pull away casual orders. Revenue on that same store drops meaningfully. Food cost climbs into the low 30s, labor climbs toward 30%, and operating income before debt service can collapse to a fraction of the optimistic scenario, sometimes down near break-even once financing is factored in. The swing between a strong year and a rough one on a single Domino's location can run into the hundreds of thousands of dollars, and that volatility is the real trade a franchisee is accepting in exchange for access to the brand, the technology, and the purchasing scale. So the next time you open the app and confirm a $7 carryout deal, understand what you're actually funding. It's a logistics network, a proprietary software stack, a supply chain that turns its own franchisees into its most reliable customers, and a real estate model built entirely around delivery radius rather than foot traffic, all wrapped around a genuinely simple product. The pizza is real. But the reason this company has quietly outperformed some of the most celebrated technology stocks of the last decade has almost nothing to do with the food, and everything to do with a series of structural decisions made decades ago by a broke 23-year-old who just wanted to keep the lights on. Subscribe, and we'll do this again next week with the next business that isn't actually the business everyone assumes it is.